Welcome back to the Exchange. Tech, utilities, and energy are some of this year's top performers now, while consumer discretionary is one of the biggest laggards. Bringing us three buys and a bail among those four sectors is Jeff Kilburg, founder and CEO of KKM Financial and a CNBC contributor. But are you smarter than a high school economics student, Jeff?
I don't know, Kelly. Those cats were pretty sharp out there. Proud of them. It was great to see.
All right, let's kick things off with tech then, and semis in particular. The SMH is outperforming the S&P this year by a cool 28%. So your buy in this category is AMD. We mentioned it. It was our mystery chart into the break. Shares are up 13% year to date, and they just announced their next-gen AI chip. Why do you like it?
Well, it's borderline blasphemy, right? How dare I fade NVIDIA? But when you look at AMD, look at the pricing power or the pricing wars that are about to happen. You look at their top-of-the-line chip, it sells for about $10,000 to $15,000. The H100, NVIDIA's favorite chip out there, sells for $40,000. So I think as we see capital expenditure by all these companies come into play in Q3 and Q4, they're going to consider going to a lower cost. Intel is in that same boat, but Intel is down about 40% year to date. So I want to look at AMD because I think there's a dispersion. There's such a dislocation. Look today, we're seeing NVIDIA up 4%, AMD down almost 3%. So I think this is a short-term trade opportunity to book profits in NVIDIA and buy AMD. But there's also a reversion to the mean, Kelly, because they will have to have some price sensitivity as people continue to spend on AI.
All right, it's a big debate. Do you go with NVIDIA? Do you turn to, as you are turning to AMD in the semi space? Let's move on to utilities then, where Duke Energy has actually been an underperformer of the ETF year to date, but it's still up nearly 7%, and it doesn't have a single sell rating on the street. Why do you like this name?
Well, Duke is just a great utility we've owned for a long time. You look at nearly 4% yield. And to your point, it's a laggard. And when you think about, no one would really probably think that utilities year to date is the best performing sector in the S&P 500. So boring is sexy again here, Kelly. So Duke is a name I think you can own moving forward. Technically, it has the ability to move back above. But all the stocks that I'm trying to buy today, they're all in the red. That's the best part about this. There is a bit of a discount here. I love buying laggards. I love owning blue chip names like a Duke Energy.
All right, let's hop from that into the energy space then. A name that we used to talk about all the time and rarely gets a mention these days, Exxon. And it's outperforming the energy sector this year by about 6 points. As consolidation continues, reports are circulating. They're nearing a $500 million deal with Shell to sell off jointly controlled North Sea assets. Why is Exxon your favorite here?
Well, if you look at Exxon and Chevron, those are two names, they're the biggest names in this space. When you see Chevron about half the size of Exxon, I want to go with the bigger name. But look at any metric between Chevron and Exxon. Year to date, 1 year, 3 year, 5 year, you've seen outperformance in the bigger market cap. When you think about blue chip names and energy, I know it's down today. I know energy's down today, but this is the second leading sector. And I think energy will continue to prevail, not just because of geopolitical tensions. It's just the fact that we continue to need energy. So Exxon, I prefer over Chevron. And I think there's an opportunity technically, despite the fact it just fell from its 50-day moving average down $3 today. I think it reclaims that 50-day moving average, and Exxon has the ability to continue to outperform for the rest of the year.
All right, let's turn then to the worst sector so far this year, consumer discretionary. One of the underperformers is Starbucks, down 15%. They got slumping sales, high-profile board exits. They've had just a tough go generally. Some people are actually now getting into this stock. I thought I just saw that last hour on the half with the judge.
Yes, Belsky.
Yeah, Belsky, thank you. So you're taking the other side of this trade. You're out. Why?
I think Belsky is just a little premature here. You look at this name, it's broken on a chart. It's completely crashed through its 50-day and 200-day. But step back for a second, Kelly. Let's talk about the consumer. We're seeing a little bit of weakening in the consumer. Sticky inflation. So what is going to be cut from consumer spending? It's the mocha choca latte $8. It's whatever you drink there, whatever people drink there, I think that gets cut first. So I think you're going to see people continue to walk away from Starbucks. That's going to hurt them short term. There is value. I understand it's discount. It's not going away, but I think you can own this a lot cheaper. But if you own this for the last 3 or 4 years, it's gone nowhere but down. So this is something you want to walk away as consumers maybe shy away.
We need a bull bear debate. You, Belsky, and a Starbucks, maybe just for him. Jeff, thanks so much. We'll see you again. We appreciate it. Jeff Kilburg.